So FHA has made a huge change in how they calculate income, which is helping people increase their buying power or how much they're qualified for. Now, they've also made certain changes to their citizenship and residency requirements. So in today's video, we're going to be covering that. We're also going to be going over the basics of an FHA loan. We'll go over certain income and employment requirements. Then I'll also show you the formula that banks use in order to qualify to see how much your buying power is or how much you're qualified for, so that at the end of the day, you can determine if an FHA loan is going to fit your needs or not. Okay, so here's why a lot of people end up choosing an FHA loan. Number one, it can be used by anyone. It's not just limited to first-time home buyers, and you can actually use this loan several times in a row. Number two, it's the most lenient and flexible as far as all the loan products out there when it comes to you can buy a house with a lower credit score, with a low down payment. And also, this is good for those that have a lot of high monthly debt. So they will allow up to 56% of your monthly income to go towards all of your monthly debt, which is a lot higher percentage than the other loan products that are out there. Now, as far as the credit score, the minimum credit score that you'll need is a 580 score. And you can actually go a little bit lower. Here's the thing though, out of 580 score, you're going to get killed on the rate and the fees. So really that next benchmark is going to be a 620. Now, when it comes to down payment, the minimum down payment that's required is 3.5% of whatever the purchase price is that you qualify for. And here's the thing, with FHA, it's a government entity, so they don't directly lend to the public, so you'll have to get pre-approved with either a mortgage broker like myself, a direct lender, or a banker. Now, let's go over the type of incomes that FHA will allow. So one of the biggest things is FHA requires you to have a 2-year job history. Now, this doesn't need to be in the same job. It doesn't even need to be in the same line of field. Just as long as you've had a job for the last 2 years with very minimal job history, that will work. Now, if you're a W-2 employee, here are some of the traditional types of incomes you can use. You can use your salary, your hourly amount, commission, bonus, overtimes, things like that. Now, if you're self-employed or you own your own business, they strictly look at your tax returns for the last 2 years. And they look at your taxable income, which is your income after all of your write-offs and expenses. Now, if you're on a fixed income, you can use that as well. You can use your retirement, Social Security, child support, alimony, things like that. Now, here's the major change and the major update that just happened last month that can help you qualify for more. They will now allow you to use what's called border income, or what I like to think of it as roommate income. And this is regardless if you own the house or if you rent the house, they will allow you to use this income. Now, let's go over the specific requirements when it comes to this type of income. Okay, so here's who qualifies or who is considered as a border. It's pretty much anyone that is living with you under the same roof for the past 12 months. Now, before, they only allowed border income if that person was a blood relative of yours and they've lived with you for the last 2 years. So they've really relaxed the guideline on this. Now, here are some of the documents that's required. So to show proof of that rental income, they're going to look at your last 12 months of bank statements and take an average of that. They're also going to need to show proof of address from that border or from that roommate. So they either need to know, look at their driver's license or a bill. They mainly want to make sure that that border is actually living in the same residence as yours. And then if you are using this income to purchase a new house, then they're going to need to look at your border agreement. And the main thing that they're looking at here is to make sure that that roommate/border is going to be moving with you into the same house. Now, if you're refinancing and you already own the home, they don't need to look at this. Okay, so here's how they calculate it. So the main thing is they want to make sure that you're not heavily relying on that border income to be used to qualify. So you can't just qualify strictly only using that border income. You have to have other income as well. And that border income cannot exceed more than 30% of your overall income. So here's how that looks. Let's say that you make $5,000 a month of salary. The border income that can be used would be 30% of that $5,000 a month, which would be $1,500. Now let's go over different tips on other types of income. Okay, so it's really important to understand how the banks look at income, how they calculate income, because income is one of the most important components when it comes to getting a home loan, because it directly impacts how much buying power you have and how much you qualify for. So when it comes to hourly income, let's say that you're not guaranteed 40 hours. 1 week week you work 32, 1 week you work 36, 1 week you hit 40. What they do is the bank looks at an average of all of your hours that you work. So a lot of times people think that by turning in a pay stub that has a lot of hours in it, that's going to help them get qualified for more. Not necessarily. Like I said, they're going to look at an average. So a good tip is make sure that you're averaging a good amount of hours, as many hours that you can for several months before you apply for a home loan. Now, if you're receiving overtime and bonus, the only time the bank will allow you to use that income if you've been receiving it for the last 2 years. Now, it doesn't need to be in the same job for the last 2 years. What they will do is they will request your pay stubs from the previous 2 years to make sure that it supports your income, and they use that as an average. Same thing with commission. You must be receiving commission income for the last 2 years. Again, they will average that amount out. Let's say you're working 2 jobs. They will only use both of those incomes from both of those jobs if you've been working 2 jobs for the last 2 years with no interruptions. Now, let's say that you're receiving child support. So if it's court ordered, they will look at the court ordered documents, and the child support must be continuing for the next 3 years in order to use it. So let's say that the child support ends when the child turns 18 and they are 16 years old. They will not be able to use that as income. Now, if it's not court ordered, FHA will still allow you to use that income as long as you have proof that you have been receiving it for the last 12 months, no missed months, and you must provide your bank statements. Now, let's say you receive alimony. They're going to make sure it's court ordered, and they're going to look at the time frame for that. If you've been receiving Social Security, they're going to ask to look at your Social Security award letter. Now, if you are self-employed or you are a 1099, what they strictly look at is your last 2 years of filed tax returns, and they look at your overall income minus your write-offs, and that's what they perceive as your taxable income. So it's really important you want to limit your write-offs whenever you're trying to apply to a home loan. So make sure that your CPA knows up front that you are wanting to buy a house. Okay, so here's the formulas that the bank use in order to determine how much your buying power is or how much you qualify for. Now, it's important to understand that just because the bank will allow you to lend a certain amount doesn't mean it's financially safe or financially a good idea for you to take that full amount. Because at the end of the day, the banks really care about the ability for you to repay them, not for financial growth. So here's what they look at. They look at your debt to income ratio. And again, on an FHA loan, they will allow 50% of your monthly income to go towards your monthly debt. And here's how they look at this. Number one, they add up all of your monthly debt that's going to be on your credit report. Then they add the estimated mortgage payment for that particular house you're wanting to qualify for. That includes taxes, insurance, HOA out the door. They add that together and they divide that by your gross monthly income. So not your take-home amount. This is going to be your pre-tax income, and that's going to give them the percentage. Now, here's an example, a real-life example. Let's say you have $1,000 of monthly debt. This is including like car payments, credit card bills, student loans. They take that amount and then we add it. Let's say the monthly mortgage payment is going to be $2,500 a month. Then we divide that by your monthly gross income. Let's say it's $7,000 a month. And that's going to give us 0.5 or 50%. So that tells the bank that on an FHA loan, they will allow you to hold a $2,500 a month mortgage payment. You will be able to qualify for that. So when it comes to debt, they are really taking into consideration the monthly payment on that debt. So it's important to really understand that you want to try and keep your monthly obligation or your monthly payments on your debt at a minimum amount in order to qualify for a lot more. So here's what they include as far as debt goes. Any installment loans like car payment, credit card bills, student loans, any child support or alimony that you're having to pay, that they will include that into your monthly debt as well. Here's what they don't include. They don't include your rent amount. They don't include utilities, cell phone bills, or how much you pay in gas. So when it comes to a residency, one of the biggest changes that has been made within the last month is they no longer allow non-permanent residents, even if you have a work visa or not, to be able to qualify to use an FHA loan. You now can only use a conventional loan to qualify. So I hope you found this video helpful. Consider subscribing, and I'll see you on the next one.